Welcome to Finscale, a podcast created by Solène Niederkorn, shedding light on innovation in finance, banking, and insurance.
"21Shares, bridging the crypto gap." Ophelia Snyder, co-founder and president of 21Co.
From day one, we've been committed to making a global impact as a business while being environmentally conscious. Our journey began with a very clear mission and one that included a carbon neutral approach to our operations. We've been working towards this goal for a long time, and it makes us one of the leaders in the industry to achieve carbon neutrality.
During an insightful discussion, Ophelia explored the nuances of the rapidly growing crypto space, shedding light on the critical role her company 21Shares plays in its development. Our discussion also covers the global crypto classification standard, the GCCS. She shares valuable insights on why the GCCS was formed, emphasizing its potential to bridge the gap between traditional finance and the intricate realm of crypto assets. We also delve into the challenges it took to get this off the ground. Ophelia shares many engaging stories about the birth and growth of 21Shares, its inception, key milestones, value proposition, and geographic expansion. During the episode, we speak about the company's diverse product offerings and the vital role its partners play, including market makers and custodians. Sustainability is a fundamental value of 21Shares, and we find out it was brought to the forefront due to their pledge to offset carbon emissions, particularly from on-chain crypto transactions. Our conversation ends with a discussion on 21Shares' green initiatives, their strategy for choosing such projects, and their vision for tackling upcoming environmental challenges. Enjoy the show! Hello, everyone. Hi, Ophelia.
Hi, thank you so much for having me today.
Yeah, I'm very happy to have you on Finscale. Can you please present yourself for a few minutes so we understand where you come from, your background, etc.?
Yeah, of course. So my name is Ophelia Snyder. I am one of the two co-founders of 21Co, the parent company of 21Shares. We started the company about 5 years ago, me and Haney Rashwan, who's one of my oldest friends in the world, to make crypto easy, to simplify the process of investing in this asset class, to simplify the process of learning about this asset class. And over the past 5 years, we've launched 30-something exchange-traded products based out of the Swiss market, but available across Europe and the Middle East. We have products in Australia, and we're launching products in the US.
Perfect. So we're going to talk about 21Co, of course. But prior to that, I was interested to know your background because you've been working in TradFi, correct?
Yes. So I have a little bit of an unconventional background to do what I do, actually. I started off my career in marine biology, actually. So I was a marine biologist in the first innings of my career and made documentaries for quite a while as well before really falling in love with numbers. I've always loved numbers. And so that led me into finance. It's, in a lot of respects, if you're not a pure math person, the place where numbers really speak and sing, and you can do beautiful things with them. And so that's what really got me into the space. I started off in banking. I worked at UBS for a while, and then at another US investment bank before deciding to start this company, primarily because my mom wanted to invest in crypto and was having a really hard time figuring out how to do that. And so my co-founder and I built a bunch of products because our moms wanted to get into the space and there was no way we could help them do that. So in a way that made them comfortable. So we decided to build a whole company to do it.
Excellent. Were you an investor at that time?
You mean
in crypto?
Oh, yes. I've been an investor in crypto, and I've been following crypto for years. I'm one of those weird people whose first intro to crypto was my mom. So in about 2013, which is ages ago in crypto, my mom came to me and she's like, I just read about this really cool thing called Bitcoin. And it makes perfect sense because if you believe in economic stability and globalization and global supply chains and economic growth, this makes all the sense in the world. You have to have a global unified currency. And Merck spends too much money on hedging different currencies. So why don't we have a more efficient system than this at a monetary supply level? And I'm like, okay, I need you to take like 6 steps back. What are you talking about? She's like, this thing called Bitcoin. I'm like, okay, I'd heard about it roughly around that same week.
Yeah.
A couple of my friends also came through and were like, hey, I'm looking at this new tech. What do you think of this blockchain? I was living in California at the time. And it was really interesting.
Sort of planet alignment. That was your time.
A little bit.
Okay.
Funnily enough, my mom, despite totally understanding Bitcoin, totally getting the purpose, totally getting what it could do to change the world, she didn't invest at the time because the infrastructure didn't exist to allow her to. Mm-hmm. Her whole statement was, I'm not going to open an account with a company I've never heard of. Now, granted, that company, fast forward, we were talking about Coinbase, which is obviously now a very reputable firm. But at the time, she's like, I don't know what this is. I'm not getting into this. I don't want to set up a wallet. What do you mean if I lose the password, it's gone forever? I'm not doing it. And so she didn't make an investment at the time. And it's probably one of her biggest trade misses.
Okay, thank you very much for this very nice intro. Ophelia, before understanding what you do at 21Co, I wanted to understand just one thing, because I've seen that you have, issued what you call global crypto classification standard with Gecko, if I remember correctly. So I wanted to maybe dig into this prior to discussing what you do and understand from you why there was a need for this classification and this standardization.
So at a fundamental level, everyone is trying to wrap their arms around a fairly complicated ecosystem. And the biggest issue with crypto assets is that they're not all the same thing. You could think of them like saying financial assets. It's that generic. You have things that look like currencies. You have things that look like commodities. You have things that look like final products, tech products, file storage, and things that look a lot like Dropbox next to things that look a lot like Cloudflare and infrastructure for the internet next to things that look a lot like Swift and things that look a lot like Facebook. These have nothing to do with each other, right? They just happen to use the same technology in the same way. It's really difficult to say internet companies. Mm-mm. What does that mean? Everybody uses the internet. We're having this conversation over the internet. People are also, sharing MRI files over the internet. It doesn't mean anything. Mm-hmm. And so crypto suffers from somewhat the same thing, which is that actually this is such a broad term and it encompasses so many different things. Providing that clarity and providing a framework to help people understand that makes it a lot easier for investors to feel confident in the space, regulators to feel confident in the space, and for people to have a functional mental model of how to think about all of these products and projects.
Excellent. So how did you start? What was the beginning? How did you build it? And can you explain? So it's complicated because it's an audio and I don't have any possibility to share pictures with the audience, but I will share it on my newsletter, by the way. But yes, can you explain a little bit how it's looking like right now with the different classes and categories?
Sure. So there's really, you're starting with a blank piece of paper, right? No one has really done comprehensive crypto classifications. So the approach that we took was really a 3-level classification structure. Level 1 is what we would call the crypto stack, and it refers to the types of crypto assets that make up this universe. Level 2 is about market mapping by sectors and industries. The idea here is to look at protocols based on which sectors they interact with and industries in the way S&P introduced this in the 90s. And it's a pretty standard thing used by the global financial community. An industry is a specific group of companies or businesses, or in this case, protocols or networks. And a sector is a large segment of the crypto economy. So trying to help people categorize that. And then finally, the last level is what we're calling the taxonomy of crypto assets. So this 3rd level classifies crypto assets based on what, superclass they belong to. So is it a currency? Is it a commodity? Those types of things. So as an example, for Bitcoin, you'd be looking at a protocol that is primarily focused on payments platforms. That's going to be where it sits in the crypto stack. From a sector industry perspective, it's an infrastructure project. From a taxonomy perspective, it's a currency. And so this helps you actually start to think about, okay, well, what other stuff is like Bitcoin? What other stuff is falling in this portion of the crypto world? And so that's sort of how we've organized this.
And how do you reconcile this with the regulatory approach that is quite different and more simplistic?
I think it's really important to think about what the challenges are here. It's really hard to do this. And part of the reason this is so difficult is you actually have to understand at a fundamental level the commonalities and differences of crypto assets, including, but also well beyond the top 100 by market value. Mm-hmm. And so from our perspective, we had to go through every single piece of documentation to understand. We actually understood how these blockchains worked from a first principles basis so that they can go into the right categories. Very similar to what, S&P and MSCI did when they came up with the GCCS to classify the stock market. Mm-hmm. We're trying to help people along this journey of education, and things like a GCCS is a crucial first step to get into the space with a holistic view of the asset class. Mm-hmm. That's sort of the backdrop. It makes it really hard to do and really dynamic. Yeah. Those things are not typically great when it comes to regulation. So GCCS is much broader and much more in depth than what we currently see in the regulatory environment. And the hope is that we can use tools like this to help regulators understand this fast-moving asset class. Yeah. Because fundamentally, you're having to reinvent sections of this fairly regularly. Not from scratch, but it's constantly expanding in terms of complexity. We're seeing a lot more collaboration between stakeholders in the crypto space and regulators. And this approach is an important step to find that right balance. Mm-hmm. And we've seen that globally. That's happened in Europe. That's how you get things like MiCA. And it's going to be really interesting over the coming months to see how that's actually implemented. But you're also seeing really exciting developments in other geographies as well, as we start to try to work towards a common understanding and a common vocabulary, which is one of the things that's most frequently missing. Mm-hmm. And it's one of the things that this global crypto classification standard is hoping to bridge.
Great. Thank you for clarifying this. It's interesting to get people to know more about this initiative. When it comes to your company, I was interested. So we understand the rationale, the reason why you decided to co-found that company and to solve clear pain points of accessibility of that new asset class to, I would say, traditional investors. Practically, what was the first product you launched? Where did you settle the company? Why did you settle? I guess it was in Zug or in Switzerland. Yeah, explain to us a little bit how it happened.
So the story of how we started this company is interesting. As I mentioned, both my co-founder and I had moms who wanted to get into the space. And so we were trying to build something for them. And when it came time to put pen to paper, we had a very clear view on what the problem was, but we weren't actually trying to start a company. We were just trying to solve a problem for our parents. We started looking. And there just weren't very many good options. You either had extremely expensive structured products, you had products with massive premium discounts, you had products that were too technical, so you had to set up new accounts for them. You could self-custody, but how are you dealing with that? There wasn't really a good solution. So we're like, okay, well, I guess we got to go build something. What's the options to build a single product, one product to support our parents, to come into the space? What are we doing? And we looked all over the world at where was the best place to structure this product, right? Because we weren't trying to build a company and we weren't trying to do anything beyond, we would like to launch a product to solve a problem. Where can we do that? What's the option set? And we took a very academic approach to it, which may sound odd, but is very much who we are as people. And so we went into this process and we looked at literally dozens of jurisdictions and different product structures. And could you, create a vehicle that looked like this or like that? What's the option set? We finally landed on a Swiss-based exchange-traded product as the actual best solution to the problem. And it came down to a few different reasons. Switzerland has a very long history with gold and gold custody and other commodity-based products, and also has this wonderful history of neutrality, which is really complementary to sort of the thesis behind crypto. Mm-hmm. And so they had the right regulatory infrastructure and the right innovation climate to be conducive to building something like this. And so we came in and started working on it. Headquarters of the company was in Zurich. My co-founder and I moved into an apartment together in that was also the office in New York.
And you were working in the bathroom.
Yeah, exactly. It was just a continuous. There was no division between work and anything else. And eventually, well, I mean, actually, in a funny, obviously that is no longer the case. I now have my own apartment, and my co-founder has his own apartment, and the office exists in a place that is neither of those two locations. But we just started working, and I had no history in Switzerland. Neither did Hanny. So it was interesting. Landed, started unboxing things, and then realized I didn't know how to get rid of the cardboard. And had to beg my garbage man to help me understand how to get rid of anything, because I actually didn't know anybody in Switzerland, like not a single human being. And that's how we started. We just started building, and we launched our first product, which is HODL, which is an index of the top 5 crypto assets with really research heavy methodology involving projected 2050 supply numbers. So everybody kind of knows that 21 million is the maximum supply of Bitcoin. That's expected sometime around 2050. Mm-hmm. But it's really hard to come up with a similar number for other crypto assets. Mm-hmm. So we built out, but we use that as the foundation because it helps you sort of normalize for those inflationary dynamics within different protocols. And it was designed to sort of help people get broad-based exposure into the sector in a smart way. And then we followed it up with 30-something additional products over the last 5 years.
Great. And did you visit the FINMA? How, I mean, from a regulatory perspective, did you, hired lawyers? And because there is a huge impact from a regulatory perspective because you propose your products to consumers. So how did you manage this?
One of my first phone calls was to a lawyer at Hamburger, Benjamin Leisinger, now many years ago. I'm eternally grateful he took my call of a person he had never heard of and had no contacts with, and cold emailed him off of the email address on his website, saying, "Hey, I want to build a thing that everybody says is impossible to build. Can you help me?" With that level of enthusiasm and eagerness.
Why did you choose him?
Oh, that's an interesting story, actually. I had read a paper on structured products in Switzerland. So part of having to figure out how to do this was I read everything available on any facet of anything to do with structured products, ETFs, different product structures, specifically focused on physical commodities and how they worked in different jurisdictions. They're bearer assets. They have complex custody. They typically run off of SPVs. It was a good fit. And Hamburger had put out a specific team at Hamburger had put out a very interesting paper on structured products that I had read. And so I went and I looked up the team. And I was looking through sort of different people who worked there and sort of different, different profiles. And his profiles really stood out because they were doing interesting things. And it worked. Productive working relationship. We still work together today.
It's great. Great story. Okay, so you have in mind your product, the legal structure, the kind of product you need to bundle together. Then you have different service provider or key partners, I would say, that you use to build your product because you don't have any infrastructure at that time. So what were the main key partners that you chose in the beginning and to do what?
Well, first came the lawyer. Because you need somebody to help you figure all this out. And I had never built an ETF before. So it took a while for me to figure out all the different pieces. There's no how-to book on ETFs. Nobody teaches you how to do this. It's still an apprenticeship model. You learn from a more senior person at your firm how to do this, and they teach you, and then you teach the next generation. And that's actually how this works. There's no way to learn how to do this. There are very limited resources on it. But there was a website at the time that was one of the industry hallmarks that had a lot of this information on it. So first came the lawyers, then came trying to figure this out. like with a blank piece of paper of like, how would you build this in an optimal situation? And then, making sure that that was legal. ETFs are interesting because they're actually like 12-ish siloed counterparties who need to agree on information every day in order to make the product go. And there needs to be a certain level of trust between them and a certain level of facility of communication. You typically look at a couple of key players. You need custodians. So in our case, we work primarily with Copper and Coinbase, but we have actually quite a broad range of people we work with to actually hold and custody the crypto assets. There were fewer options at the time. Actually, neither one of those two were in our first iteration of the product because they didn't have products that met those needs yet.
Yeah.
Although now they have fantastic products that I think very highly of and amazing teams that built them. But at the time, that was not the case. Mm-hmm. So first you start with custody because you need somebody who can actually hold on to these and is willing to be on the other side of a security at a time when it was unclear if you could even do this. You need market makers as essential components who are actually going to trade this, right? So you need a place to hold the crypto assets and then you need somebody willing to actually link that to a public market. Mm-hmm. Then in addition to that, you have a bunch of steps in between. And so depending on the products that you work with, you've got, index providers who are providing data. You've got administrators and accountants that need to do a bunch of accounting transactions to make that work. In normal ETF land, you pick up the phone and you call one of 5 large companies that offer that service. Everyone in ETFs uses the same ones. They are bundled together with custody. So you get your custody and your administration and accounting together. In crypto, you cannot do that. None of those companies service these assets. So what you end up having to do is you have a custodian who's a specialist, and then you have to you can't really find an administrator in the same way. So you end up like bringing together a bunch of different service providers to help bridge that gap. In our case, we also built a fairly robust software platform called Onyx that actually manages that process for the company.
From start, or in the beginning, you had to do it partially manually?
From the get-go, yeah.
Okay.
So we had a first iteration of Onyx maybe within 2 weeks of launch to help process and manage orders. And it's gotten increasingly complex over the last 5 years, but that initial kernel of a project, yes, you need it at the beginning. Because normally you can buy it from somebody, but in this case you cannot. So how are you taking orders from people? How are you managing that primary market? How are you doing the data distribution on the back of it? The options are you can send about 40 emails by hand a day and try to make sure that not a single decimal point is wrong. Or you can build some software that helps you do that.
Yeah.
And those are really the only two options. We had a plan A and a plan B, both of which were using some of these big shops that we thought would be able to get there in time. And we had a plan C that was this like secret project to like try to figure out how we could do it without them. And inevitably we ended up with plan C, but it's actually been a really important feature of our business going forward. The use of these types of platforms has allowed us to be more effective, more flexible in the products we bring to market, and quite frankly, safer when things go badly. Crypto can be volatile. There have been a number of black swan events in crypto. A lot of the systems that we've developed over the last 5 years have enabled us to execute really, really well in those circumstances and continue to serve clients through that kind of turmoil. And so this thing that maybe was not our first choice has actually ended up being really beneficial.
Great. And how did you get your first clients? I mean, did you use intermediaries like, advisors, family offices, private banks, wealth managers?
Yes, all of the above. So I think our first clients, it was just a question of like, hey guys, talk to us. We're not crazy. And no, we're not selling you something illegal. Because that was actually usually the question.
Of course.
Is how is this legal? And we're like, no, it is. Here's a bunch of information about that. That was the early innings. So initially, and this is true generally with ETFs, but especially true here, our client base was a lot of family offices, high net worth individuals, and retail that were interested in the space. It's been a process of education and a process of collaboration to bring on the more institutional ends of the market. And every year you're seeing more that sort of upper end on the sophistication scale come in, right? With the very sort of top of that being pension plans and insurance that have a tendency to be very specific in the way they enter investments all the way through to advisor platforms, private banks, larger banks. And you've sort of seen over the last 5 years growth from that initial sort of family office, ultra high net worth, people who were really interested in doing interesting things. Mm-hmm. You've now seen that adoption scale tremendously, and our client base is a lot more diverse than it was in the early days.
And what are the main growth drivers right now?
So, and I think this goes to what I was saying. I think you're seeing a lot more mainstream adoption, and you're seeing a lot more interest from institutions. And everybody likes to say that as sort of a throwaway comment, but you can really see it in the data around how order sizes are getting bigger. They're getting, you're seeing more OTC flow. You're seeing more, you're seeing different kinds of players come into the space, and those players, have many more assets to deploy. And so you're seeing them beginning to dip their toes, but that is a very interesting change in the market over the last 18 months. And I think everybody loves to say this as a trope in crypto. And I think it's sometimes underappreciated that bears are for building. This is actually when you're going to see most of that major interesting technical innovation and interesting work have been put in ahead of, the next leg up in the market. And I think that it remains to be seen when that next leg up comes, but I think you'll see that the companies are very, very different and the customer bases are much more sophisticated than they were in the last market cycle.
Yeah, clearly. One last thing I wanted to discuss with you is the carbon neutral engagement commitment you have. 21Shares aims to make the crypto market accessible to everyone. That's what you say while prioritizing sustainability. And we all know that cryptocurrency market has been and currently remains criticized for its environmental impact. How do you ensure that you will be able to commit and align with that very strong commitment?
So from day one, we've been committed to making a global impact as a business while being environmentally conscious. Our journey began with a very clear mission and one that included a carbon neutral approach to our operations. We've been working towards this goal for a long time, and it makes us one of the leaders in the industry to achieve carbon neutrality. And our commitment to that extends to exploring really any initiatives that promote sustainability. Our goal is to drive innovation while remaining carbon conscious and contributing to a greener and more sustainable future fundamentally. The crypto market has typically been criticized for its environmental impact, especially around things like proof of work. There's a couple of pieces to this. There isn't that much proof of work left. Let's just start with that, right? The transition of Ethereum from proof of work to proof of stake, which was a 90, let's say more than 95, I want to say 98, maybe 99% reduction in energy consumption has meant that as an industry, we are actually a lot greener and cleaner and energy efficient than we were a couple of years ago. Mm-hmm. A lot of what we do to ensure we're living up to that goal is we invest in research and development to explore solutions to promote sustainable cryptocurrency operations. We're constantly needing to adapt and refine these strategies as the industry is evolving, and balancing that accessibility with sustainability is a complex challenge, but it's been a core part of our DNA for a long time. And it's our view that it's crucial for the long-term success and acceptance of cryptocurrencies.
Mm-hmm. And you also invest in green projects?
We do. So we obviously we run an offsetting program for our carbon emissions. There's a fairly complex process involving several steps and verification mechanisms for how we do that. And we really do try to ensure that is transparent, verified, and adheres to established standards in order to ensure that these are effective. Mm-hmm. The types of initiatives we get involved with vary, and they vary based on a few different criteria. we work with some really reputable counterparties to help us identify those opportunities and help us choose projects to engage with. We work with providers to sort of allow us to ensure that we're offsetting appropriately. And we actually, the provider we work with is based in Switzerland and works with a lot of the largest companies in Switzerland to enable us really to make those investments and participate in those projects in an effective way that makes sure we're actually living up to our commitments.
Great. Thank you for your transparency. Ophelia, one last question regarding your next step. I'm always interested to see how the company sees themselves in 2-3 years. What is the vision for the coming years? And yes, what are your plans?
So some of our plans are public, some of them are not. We started off with this really simple idea. Make crypto easier, make crypto more accessible, and bridge traditional finance and crypto. That's the whole game for us as a business. And so what you've seen from us over the last couple of years and will continue to see is a few pillars. We're expanding geographically. So we started off as a Swiss business, expanded into the rest of Europe, expanded now into also the Middle East and Australia. We just now we're also expanding in the US. So obviously we're hoping that we'll be able to get a spot Bitcoin product approved, but we're also coming to market with some additional products in the US. We'll also look at a broader range. We have a really interesting range of single asset trackers. It's the broadest in the world in order to support really any kind of portfolio clients are interested in making. We have an index suite that we're continuing to work on, as well as short products. And I think you'll continue to see more products from us, a broader range, and more diversity in the different types of portfolios that you can invest in. And then lastly, I think one of the other pieces of our business at the 21Co level is we also recently launched a range of wrapped assets, which are tokenized products focused on safety and interoperability between blockchains for use in DeFi projects. So of the top 10 assets in the space, most of them do not exist on the same blockchain. So it's very difficult to have a technology that bridges those two things and actually allows you to connect these different networks. Bridges as a category have been one of the largest sources of hacks and losses in the crypto space. And so we're aiming to solve that problem by bringing a new solution that doesn't rely on bridges, but actually allows us to have safer cross-chain assets. And so we're also looking at a lot of on-chain projects and a lot of crypto native projects as we look towards the next year or two of the business.
What a roadmap, huh? Impressive.
Yeah. That's to the team's credit. We're a very high performance team. We get a lot of stuff done. And we do it effectively, and we do it in a way that always puts our clients first.
Yeah.
And I'm actually very proud of that.
You get things done. We can feel it.
We get things done. That's all that matters at the end. We get things done, and we do it in a way that our clients seem to really like and enjoy.
Great. Ophelia, to conclude, I always ask for a recommendation. So what book would you recommend to us today?
I'd love to read. Book recommendations are always so challenging for me because of that. But I think, given what I've been asked to talk about today, I'm going to pick a sector relevant book. I really like history, and so that may explain the choice. There's a wonderful book called The Infinite Machine by Camilla Russo, which is a look at the early days of crypto, especially of Ethereum, and is a wonderful read for people, both if you like history and if you have an interest in crypto.
Thank you very much, Ophelia. That was very interesting. Thank you for your generosity.
No, thank you so much. This was fun.
And the crispy anecdotes. I love your crispy anecdotes. See you soon. Bye-bye. Thank you all for listening and sharing this moment with us. Don't hesitate to contact me on Twitter or LinkedIn to share your comments and reactions. You can also rate this episode on your favorite podcast platform. See you soon.